मरघट तक है तेरी कहानी, पग पग प्यारे। दंगल 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 दंगल, सूरज तेरा चढ़ता ढलता गर्दिश में करते हैं तारे। दंगल 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 दंगल।
Great morning, my dear friends. Bhupeshanand this side again. So today we'll be starting with equity valuation concepts and tools, and we will be in the lecture number 2. Now, before we start with lecture number 2, I have given you a quotation today. Push yourself because no one else is going to do it for you. It means we have to push ourselves for June and December because no one will be going to push us. So with this thought, we will be starting with lecture number 2. And I hope that you please take out your registers. Equity, last reading which we are doing. This is the second lecture, lecture number 2. And today we'll be starting with equity valuation concepts and tools, some insider part. In the last lecture, I have told you that what is the meaning of a difference between price and a value, and what are the different methods in valuing that, in calculating the value. And within that, we have discussed discounted cash flow method. And within discounted cash flow, there are 3 methods to calculate cash flow. One is dividend discount and model. Second is free cash flow from firm, free cash flow for equity. So today we'll be putting my best efforts to give you good examples, to give you practice examples on discounted cash flow, and that too dividend discount model. So let's start with the journey. The point number 1, please take out your registers. Please write down discounted cash flow. In discounted cash flow method, there are 4 methods in valuing a stock. We are doing first method, discounted cash flow method. In that there are 2 components. One is the present value factor and second is the cash flow. The first point is in discounted cash flow, the cash flow component, the component number 2, which is very important, that can be calculated with the help of 3 methods. The first is dividend discount model. The second is FF, free cash flow for firm, and free cash flow for equity. So let me start with the journey. Cash flow can be of 3 types. Now the point is cash flow can be of following types. One is the regular cash flow and second is a terminal cash flow. When I say regular, I mean operating cash inflow. When we start a project in capital building, in corporate finance, we did that. Whenever we start with a project, there are 2 types of inflows which we are getting as an investor. The first is operating cash inflows, that is recurring cash inflows, that is which we will be getting regularly at regular interval of time. And second is the terminal cash inflow, which we will be getting only at the end of the project. You're remembering that? So the same concept I am using here in equity analysis, in equity valuation. Even in equity valuation, we will be getting 2 cash flows. One is the regular cash flow, and that is named as dividend. And second is a terminal cash inflow, the inflow which we will be getting when we sell that share, that is named as terminal. So I have written dividend as a regular cash flow, or when I use capital building terminology, I will be saying it as operating cash inflow, and this is terminal cash inflow. It means when we are doing discounted cash flow, because we want to discount the future cash flows, and we want to calculate the present value of all those future at today's time. So at least I should be aware of that how many types of cash flows are there. So I will say there are 2 types of cash flows. One is regular cash flow, which I will be getting as a holder of equity, that is dividend. When company declares dividend, it is not compulsory that every company should declare dividend. It is neither compulsory as per Companies Act or by any regulation also in USA. Even in India also, dividend to be paid to equity stock, it is not compulsory. And the second is terminal cash inflow, which an investor, because I will be calculating value from the investor's point of view. I am taking into account the investor's mind, that what investor will be getting after investing in this, after paying the market price, how much he will be getting the cash inflow. So he will be getting future cash inflows, and future cash inflows are of 2 types. One is regular and second is non-recurring. When I say regular, it means dividend, and when I say non-recurring, it means terminal. So the basic part is I want to discount these 2 inflows. Now how to discount it? Because I am getting it in future. I am getting in after first year, second year, third year, fourth year, fifth year, and sometimes perpetuity we are getting it. So how to discount it? Which discounting rate is to be used? Which is the required rate of return? Which is the appropriate rate of return? How to calculate that? So I will be taking the help of cost of equity, because we are doing it from investors' point of view. You getting my point? I am doing it from investor's point of view. So for an investor, he will be expecting how much amount of return he will be getting from this investment. So I will discount these future cash inflows on the basis of cost of equity. Do you remember we have calculated cost of equity as per CFA model, capital asset pricing model. So we can use CFA model also for calculating cost of equity. I am not going in that aspect. The point is, it is very important that we should know what is the discounting rate, what is the role of discounting factor, and the note number one, which I have just told you, it can be calculated with the help of CAPM. So I will be solving some practical problems. So please take out your calculators also. I told you the first lecture that if you want to learn how to drive a car, two things are important. First is skill, which I have just given you. Second is the practice. Practice makes the man and woman both perfect. So we will be doing lot number of examples so that we can easily solve practical problems from CFA curriculum, and at the end we can score good marks in June or December. So please start writing this example number one. In each example I have given you special different features. So all the features I have divided into 6 or 7 examples. Now by doing those 6 or 7 examples, I can assure you that we can able to solve all the questions in relation to this concept. So example number one, we have to calculate the value of the stock. That how much is the value of the stock? Expected dividend in D1, year 1. It means how much dividend I will be getting at the first year. That is, expected means I have not received it. Dividend to be received. Next year dividend. Now these words are very important, whether the dividend is past year dividend or next year dividend, because we have to discount future cash inflows. So we have to see whether that dividend has already been paid, whether it relates to past year, whether it is a last year dividend, whether it is a past tense or whether it is a future tense. We are concerned with future tense. So if we are not given the future tense, we have to calculate future tense with the help of growth. Past tense plus growth in past, that will be equal to future. It means D1, expected dividend, which we have discussed in corporate finance while doing cost of capital. So expected dividend is D1 is 30 rupees or $30. Expected stock price, it means if an investor wants to sell it after 1 year, then he will be getting 100 rupees or $100. And the expectation of that shareholder, expectation, how much is the appropriate cost of equity, that is 15%. So I will be calculating the value. So it means I am standing here and I will be getting something here, some here, some here. It means all future cash inflows will be discounted, and we will be calculating the value of equity at this particular point of time. So it is better to prepare. It is better to prepare. It is better to prepare a timeline. So I have prepared a timeline. So you also prepare a timeline. T0, T1. Now at T1, I will be getting two cash inflows. One is dividend and second is, if I sell that share, I will be getting some sale price from that. So dividend is 30 rupees, $30 I suppose, and the amount which I will be realizing by selling that share is $100 or 100 rupees. The total amount will be $130 or 130 rupees, and the discounting rate is 15%. So I can use the calculator and I can calculate the present value with the help of TVM row. And I have written those steps. I have written all the steps, that what are the steps to be taken into account while you are doing, with the help of calculator. So I will be using TVM row. Second, clear TVM, because we have to clear the history. 130. Now how 130? 30 is the dividend and 100 is the sale price. So future cash inflow is 130. 15 as interest, 15 as IY, and then 1 as N, because only there is year 1. Compute present value. So I am computing present value, and that is coming to as 113 rupees. So compute present value, and that is coming as 113 rupees. So this is the value of the stock as per dividend discount model. So this is just the beginning. I have just told you how to calculate the value of the equity on the basis of dividend discount model, and we will be discounting, we will be calculating the present value of all these future cash inflows. Now, let's start with example number 2. A new feature, a new point I have covered in example number 2. So it is important that you should write down all the examples. My dear friends, please sit straight and please write down all the examples. Find out the value of the stock on the basis of following numbers. Now I have to use, I have given some numbers, some information, and on the basis of that information, you have to calculate the value of the stock. Cost of equity is 10%. That is expectation, appropriate rate, required rate as per CFA, as per cost of equity. Perpetual, because in case of common stock, common equity stock, there is no redemption. You're getting a point. No redemption is there. When there is no redemption, it means I can say the life is perpetual. And in case I am given the perpetual life and then I have to calculate the value, I can also do it. In first example, I have assumed that the life that the investor has sold at the end of the year one. Then I have taken into account that sale price. But in this example, I am assuming that the investor has invested perpetually for infinite period. So if I am given the perpetual life, then also I can calculate value of the stock with a very simple concept. D, cash inflow upon capitalization rate. Cash inflow upon capitalization rate. So just see to it. I have prepared a timeline again. 2020 will be the future cash inflows which I will be getting up to infinite period, and V0 is equal to D upon KE, that is 20 upon 0.10, that comes to 200 rupees or $200. So with the help of these two examples, I have at least gotten a resemblance that how I will be calculating value of common stock with the help of dividend discount model. So let's start with example number 3. So this is the last example of this today's lecture, but in next lecture also I will be discussing some more examples in relation to dividend discount model, because I want to cover each and every point in dividend discount model. So this is example number 3, a new feature, a new point I have added. I have added the growth rates. I have given you the dividends, past year dividend. Now, when past year dividends are given to you, you have to calculate next year dividend, future year dividend. So calculate value of the stock on the basis of following information. Dividend at T0. Now it is given as T0. It is past tense. It has already been paid. Last year dividend. So whenever it is last year, we are concerned with future year. So we will be calculating future. So 20 is D0. So we have to calculate future year dividend, D1, D2, D3. Growth rate. Growth means how much will be the growth in the dividend the company will be giving in first year, second year, and third year. 1 to 3 means in first year, in second year, as well as in third year. Growth rate is 10%. In fourth year and fifth year, the growth rate is 5%. Okay. And the expected stock price at the year 5, it means I will be selling it at the end of fifth year, that is 200 rupees, $200, and the cost of equity, that is appropriate discounting rate, or the CAPM, as it can be calculated by any either way, that is 10%. So my tip to you will be, please always, while doing practice, you should prepare a timeline, because when you prepare a timeline, the whole concept will be very much clear to you. So in this, I am getting 5 inflows, regular inflows as dividend, and I am getting a terminal cash inflow at the end of fifth year. It means at the end of fifth year, I am getting 2 cash inflows. One is dividend and second is sale price. So timeline is as follows. So this is a timeline. But the point is, firstly, I have to calculate D1, D2, D3, D4, D5. This is the main point in this example, that I am not given with the future cash flows in relation to dividend. That is to be calculated, but I am given with the growth rates. So D1 is equal to D0 plus growth rate of D0. D2 is equal to D1 plus growth rate of D1. D3 is equal to D2 plus growth rate of D2. D4 is equal to D3 plus growth rate of D3. So like this, I have calculated 22 rupees, $22, 24.2 rupees or $24.20, 26.62 rupees or $26.62, 29.34. So these calculations are very easy. Just firstly write down and please calculate with the help of your calculator that whether I have written this or not. D1 22, D2 24.2, D3 26.62, D4 27.95, D5 29.34. Now, after I have calculated all these, so I have prepared a timeline. I have written 22, 20 in the flags. But in the last year, just you see, I am assuming that because the investor will be selling at 200 rupees or $200, so he will be getting this plus this. Now, I can calculate within seconds the present value of these future cash inflows by using cash flow function. I am not using TVM row because it will be, because cash flow function we have to calculate present values of different cash flows. So it is better if you use cash flow function from your calculator rather than TVM row. So I have written the steps, that what are those steps to be taken into account while calculating or while doing this cash flow function. So cash flow function, second, clear TVM. So I will be firstly putting all the figures. CFO, that is first cash. CFO, that is how much is the cash flow you are getting in the zero period, that is zero. Cash flow in the first year 22, that is dividend only. Cash flow in the second year 24.2, again dividend. Cash flow in the third year again 26.62. Cash flow in the fourth 27.95. Cash flow in the fifth year 29.34 plus 200, that is 229.34. So this is the important point which is to be taken into account, that in the year end 5, that is at the end of fifth year, there are two cash inflows. One is dividend and second is sale price. Then I will calculate NPV. When I press button NPV, the calculator will ask me how much is the interest rate, how much is the discounting rate. So I will put in 10% as discounting rate and then compute NPV, and that is coming to be 221.49. So this is the present value of all the future cash flows which this investor will be getting. And after calculating the present value, after calculating the value of the stock, we can compare it with the actual market price. Now, if actual market price is more, if actual market price is equal, and if actual market price is less, we can calculate accordingly. Hope you have calculated along with me. Hope you have used this calculator. Hope you have understood these concepts. We will be carry forward this concept in the next lecture number 3 also, because I have to do some more examples on dividend discount model. Hope you have enjoyed. Be happy, be jolly, be cheerful. Be happy, be jolly, be cheerful.